Hello, everyone. Stephen Furness here, Director of MGD Wealth and Chair of our Investment Committee efforts here. This recording is in early August 2025, and I'm always pleased to talk to Matt, but pleased to welcome Matt Wacher, Chief Investment Officer, Asia Pacific for Morningstar Investment Management. Welcome, Matt.
Thanks, Stephen. Great to be here again. Pleasure to talk to you as well.
Yes, very good. A lot of our listeners would have had the pleasure of listening to Matt before, so we appreciate your time for this quarterly update, market update. Lots been going on. Just for reference, we remind viewers that this is general advice only and shouldn't be construed as personal financial advice. As always, if there's any queries arising out of today's discussion, then please reach out to your MGD client advisor, and we'd be more than happy to run through those queries. So, Matt, this is sort of relevant to the June quarter that's sort of just wrapped up in terms of statistics coming out. I thought we'd chat about the economic backdrop, and then we can have a discussion around how that has influenced markets or likely to influence markets. Sound okay?
Sounds great.
Excellent. Just going through the slides, we won't go through everything, but certainly inflation's come off the boil from sort of the 22, early 23 periods.
It certainly has. It's been obviously up around 7, 8, 9%, getting to lofty heights there in 22 and 23, and it's certainly come back a long way. I guess the RBA and the Fed as well, they're kind of still a little bit cautious on whether the job is fully done. We've seen that obviously the RBA not hiking in July, and the Fed kind of pushing back on the pressure from President Trump as well. But we really that last little bit of getting it back, especially in the US, of getting it back down towards that 2% range is proving potentially a little bit more difficult than people might have expected, say 6 months ago, and that's really probably on the back of some of the tariff noise, some of the price pressures coming through in the US. We would say that that's a little bit, and you see that on this slide as well. You see that the consumers are expecting inflation to rise, and we would say that that's probably more a one-off. The tariffs will flow through the US economy, and hit inflation. It's probably not going to be a kind of sustained upward pressure on inflation. We think that probably growth is going to be a bigger issue in the US to worry about than inflation, but we may get to that. And in Australia, we think inflation, the job is almost done. The RBA is still very cautious, but it's largely in the range. Inflation, core inflation, maybe a little bit further to fall. But to get the RBA really comfortable, but we're in that range, and we would expect in both Australia and the US that rate cuts will come over the next little while.
I probably shouldn't ask you, but you got a view on the most recent RBA decision?
Yeah, our economists kind of were thinking that they could have cut rates, but and we weren't alone. I think the whole market, there was maybe only 2 or 3 analysts that thought they wouldn't. And I think that was really on the back of that the RBA, the noise coming out of the RBA was that they were contemplating cutting 50 basis points back in April or May. It was very close to a much bigger cut. It kind of makes sense that the markets, bounce back very strongly. Unemployment hasn't been terrible. And actually we've seen some data just very recently, even today, that shows the consumer sentiment has bounced back to reasonable levels. So, it's in hindsight, it's kind of potentially not too big an issue, but I think that certainly looking forward, that the economy can afford to have a couple of rate cuts. I think that the
Yes.
markets are pricing in 3, potentially even 4. That may be getting a little bit ahead of themselves, but we would see that there is a need for a couple of cuts. And you've seen markets be reasonably supported around that as well.
And just with the inflation, the forecast part of this graphic, a more stable inflationary environment, you're obviously predicting for the next few years. Does that create a more certain environment for businesses and investors to operate in?
Yeah, I think and that's the key thing, and I guess obviously the reason that central banks want to, maintain a steady inflation rate, not too low, not too high, because it gives a bit more certainty to businesses. It's a much better environment for them, for businesses to be able to plan investments and those sorts of things, and when they didn't know back in 2022, 2023, not to mention the COVID period as well, how their supply chains were going to be affected, how costs were going to, flow through their supply chains and hit their businesses. It made a very difficult, investment environment for companies as well. And that uncertainty certainly fed through to balance sheets and investment generally. I guess the one key exception there globally was that the big tech names certainly wanted to be investing in semiconductors and have really banked quite a few of those.
Exactly. Economic growth or global growth, not great on this front for the time being.
Yeah, I mean, I think that it's not the end of the world. Still we think that there's still going to be some growth, but it's certainly turned down. There's certainly some uncertainty out there with how tariffs are going to affect things. Not so much in the US. I think there is uncertainty in the US, but really in some of the other regions, especially Europe, Japan, and some of the emerging markets, they really don't know how the tariffs are going to play out, whether there's going to be any more relief. It makes it hard to plan and to negotiate with President Trump, and how that's playing out at the moment is really creating an environment of uncertainty. And we think that that's probably the key thing that's hitting growth at the moment. Consumers obviously seeing that there's uncertainty, don't know whether there's going to be this is going to trigger inflation. It's an uncertain environment. And so when you've got assets, and we'll probably get to this, but when you've got assets that are kind of pushing back towards all-time highs, we would start to get a little bit cautious again after having thought that there were some good opportunities earlier in the year to invest in risk assets.
Yeah, well, we were chatting offline about that April opportunity, somewhat different today, but we'll touch on that. Australian growth looks
it's not bad.
Solid.
Pretty solid. I mean, it's not hitting the ball out of the park by any means, but we think that it's going to keep ticking along. I guess the key thing is how again, it's always China, how China's affected by these tariffs, how that's going to, if China's repositioning towards the consumer and they can kind of get their property sector under control, then that will probably be supportive of the Australian economy. The pivot away from kind of infrastructure we think that there's still going to be a need for them to be purchasing commodities. And of course, there's other areas like India as well that are starting to really look at infrastructure there, and they've got a long way to go to a long runway of infrastructure build that could be supportive of the Australian economy as well, or the Australian miners and subsequently the Australian economy.
Yeah, very good. Interest rate settings. You've sort of touched on this before, but
I think
cycle continuing.
We think that there's definitely room for a few more cuts. We think we don't necessarily forecast interest rates, but we kind of want to know the environment that we're investing in, and we think that there will be more supportive monetary policy in the second half of this year and potentially in the first half of next year. As you can see from this chart, kind of the market is expecting rates to then rise again on the back of some solid growth. But yeah, we would say that we're at a point where we think the RBA can afford to cut rates a little bit and not lose control of inflation.
Very good. Geopolitics, we've touched on that. We're all aware of what's going on in the world.
That's right.
It's a daily news cycle.
If you can understand this chart, that chart, then you're doing better than me.
So yeah, inflation, growth, policy, interest rate policies, and things like that, and the geopolitical world is sort of the takeouts of
Indeed.
the economic backdrop. The market, investment markets, fitting into that backdrop.
Yeah, I mean, so these are all headlines from that start of April, the kind of, I guess the 1st or 2nd of April, our time, through to about the 7th or 8th of April. And if you'd invested on the basis of these headlines, you'd be poorer today, having the markets bounce back very strongly. We as I said before, we took it as an opportunity to add some growth assets. What we also saw in the first quarter was tech stocks in the US, areas of the market. The Aussie market was down quite a bit. Tech stocks in the US down quite a bit, and so stocks like Nvidia, stocks like Microsoft, etc. Some of those big name tech stocks, leaving aside Tesla, sorry, not Telstra, Tesla, that was down, maybe even 30 or 40%. They were all down about 20% or thereabouts. It's certainly at the start of April and started to look a little bit attractive. Not hitting the ball out of the park. We weren't hitting sixes there, but certainly they started to look more attractive than they had for quite a long time. And so we took the opportunity to add some growth assets there. And I guess the key message, and you see some of the messages that we put out, is much more factual, I guess, than the kind of news headlines. But all around, take the opportunity of volatility to invest if you've got a good process around that. And if you're investing for the long term, you certainly don't want to be going to cash. And I'm sure these are messages that you speak to your clients about. That it's staying the course and making sure that you're taking advantage of the opportunities, not running away from them.
Yeah, and as you rightly pointed out, that period around March through to May, classic case of it is very difficult to time markets.
Exactly, and we wouldn't say that we didn't think the market was going to bounce back so quickly. That's more luck than skill. But certainly there were some good opportunities at hand there to take advantage of.
Very good. Volatility. Well, we're certainly aware of the level of volatility on the markets, which is sort of what we've been talking to.
Yeah, I guess the interesting thing on this chart is that bond volatility is still remain, equity volatility subsided a little bit. Bond volatility is remained quite high, and that's really probably on the back of the US debt story and how that's going to play out. I guess certainly at the long end of the curve, there's lots of pressure there. Although people do seem happy to come in, buyers do seem to happy to come in around 5% for the 30-year and at 4.5% for the 10 years part of the curve. But yeah, bond volatility is sometimes the canary in the coal mine, but the equity markets are ignoring that at the moment.
What have we got here?
So this is just
certainly back.
Yeah, just always, it's a Google trend kind of thing, and just showing that this geopolitical uncertainty, spikes up at times. The markets have really just looked through a lot of this noise. Even the Ukraine war. I would, in February 2022 and Russia invading the Ukraine back then, I would say that was the market's volatility was much more a inflation story than the invasion itself. And the US bombing Iran and things like that. I think that on the Monday morning, the Sunday night in the US, people were thinking the markets were going to open up and it was going to be blood on the streets. And actually, the markets were up, and US futures were up for the morning. So yeah, I don't think you can't really trade these kind of events. I mean, there's people out there that do, but we much prefer to focus on valuations and looking through the long term. And if these events cause some volatility to take advantage of, then we'll do that.
Yeah. So just, you were talking that early April presented an opportunity to top up around whatever it was, 7th or 8th of
Yep.
April being the lowest. Markets have run very strongly since then. You sort of, do you take the opposite view at the moment as a house, or?
Yeah, look, I mean, when you look at valuations, I guess, even if we go back to the start of the year, we thought the US was reasonably expensive, big tech, not at all time expensive levels, but it was starting to get up there. That sold off a bit and actually had this rotation into kind of the emerging markets and European assets. And so that rotation kind of played out. And then you got to a point in late, February, where actually everything was starting to look a little bit expensive after a good run from the rest of the world versus the US, the first time that had happened for quite a while. And so you got the opportunity in early April when markets sold off more broadly to add some growth assets, and now we've seen the US has run quite substantially, but so has other areas. I mean, China's come off the boil a little bit from its all-time or from its highs of earlier in the year, but it's certainly not as good an opportunity anymore. You saw areas like Korea and to a lesser extent Brazil and Mexico, for example, in emerging markets, pushing through all the tariff noise and getting on a run. Korea is another area that did very well, and Europe, I guess, has done really well relative to what you would have expected. And so now we're in this position where we want to remain invested, but there's just not that many investments out there that are adding lots of significant value, and you're not really being rewarded for the risk that you need to take. So we have been taking a little bit of growth assets off the table. Earnings have been coming through, and that they've been reasonable. We'll see how the Aussie earnings season plays out. That's underway right now.
Yeah,
but it is an environment where there's lots of this uncertainty that we've been talking about, and you may, if you take some risk assets, if we take some risk assets off the table, the difficult area, the question is where to put them, but you may get another opportunity to buy into some of these better assets, so these great assets at different levels. So what this is showing, this chart is just showing the way that the markets played out in the first part of the year. S&P 500 obviously up significantly in the first half last year versus the equal S&P, if you were equal weight everything. So, but what that's saying is that it really was driven by those large cap names, and then you can see if you're a bit more diversified in it helped those that were a little bit more diversified in the first half of 2025. But if you were to roll that back, those returns back to the end of the first quarter, the equal weight would have outperformed by quite some margin. So there is some value under the hood, both in Australia and US. And what I mean by that is there's some assets that look reasonable. If you're pushing away from some of the big tech names, this is the US that we're looking at here, the S&P 500. And if you look at areas like healthcare or even some of those beaten up consumer discretionary names, the likes of Nike, for example, that not only it's had a period of bad management, but also it's getting hit by the tariffs. There's a multiple catalysts for a stock like that to do well, and so we've taken advantage of some of that in these sell-offs. And areas like healthcare that you're getting reasonably cheaply as well, and it's had some defensive qualities, is something that we've put on the table as well. And you can see that the returns in those kind of areas have been poor relative to the rest of the market. So valuations have kind of improved.
Yeah, certainly. We don't need to remind people that for me, it's much better to see a more broadly based return set rather than what went on last year or the last couple of years with the Magnificent Seven. It's
Yeah,
I
I
get a
mean,
lot of confidence.
I think the way I describe it is that it's lots of those Magnificent Seven. Most of the seven are really very high quality, excellent companies that you'd love to own. But like the best high jumpers in the world, eventually they knock the bar off, and they live to fight another day. But the market falls in the meantime, and yeah, that's the key issue with those stocks at the moment, that they're getting close to knocking the bar off again.
So we've been talking about interest rates previously, and bond market volatility. It has been an unusual time for a
It
few years
has,
for bond
and
markets.
yeah, I mean, obviously you had um, you, it's obvious in hindsight that if you're going to buy 10-year bonds at kind of less than 1%, that you're probably going to get hurt. If you're going to buy anything of longer duration than that, then you're going to get hurt as well. But what we've seen more recently is that real yields, like yields minus inflation, are quite reasonable, and you can get some pretty good returns out of bonds at this point in time. There are risks of yields continuing to rise. So I guess we would prefer to own government bonds, Australian government bonds or even US government bonds at this point in time. Credit, so investment grade credit and certainly high yield, and spreads there are starting to get quite tight again. Doesn't mean the all-in yield is higher than you can get for quite some time. So the bond yield plus the spread. But what spreads are saying to us is it's time for a bit of caution here as well. Emerging market debt is an interesting opportunity, not so much for the yield, but some of those emerging market currencies look very interesting at this point in time. So if we have a couple of good emerging market managers that we use, and they are taking advantage of that as well.
Very good. And I think this is towards the end of our slide pack.
And certainly, this is just showing us, I guess, what's happened over the last few months. To really just a couple of weeks ago, and you saw that big sell-off, over just a matter of days. And as I said earlier, the US markets had sold off even before that. So US markets were down almost 20. The S&P was down probably about close to 20% to that April for the year to that April date. And then you've seen this big bounce. So 27% for US equities, global equities up about 24%, and Aussie equities bounced back very strongly. Didn't fall as much over that period, but certainly bounced back 17%. I think it was the best quarter or the best bounce back that the Aussie market's ever seen from that kind of sell-off. Or that's what I read somewhere. And you've seen some really impressive returns from there. And I guess as we were saying, stock movements like this, start to push valuations back towards, maybe unsustainable territory. So we're doing lots of work making sure that we're, being rewarded, or our clients that are invested are being rewarded for the risk that we're taking on their behalf in our portfolios. It's the most important thing.
Yeah, absolutely. And certainly, as you well know, we've got a really good range of consultant and research partners we work with, and governance and robust portfolio implementation, certainly at the heart of our investment philosophy and implementation. So, and Morningstar and Matt and your team are certainly a key part of that.
Thank you very much.
Certainly, as a business, we feel our clients are in very safe hands. So we appreciate the time today, Matt, for the update.
Appreciate the support, and we certainly want to do everything we can to help your client and you, Stephen. It's been great to join and have a chat.
No, very good. And just another reminder about the general advice nature of this chat, and certainly our viewers feel free to reach out. Thanks for your time, Matt, and we'll catch up down the track.
Thanks a lot.
Cheers for that.